Hello everyone, welcome back to episode 2 of IFRS versus US GAAP. In episode 1, we spoke about the key differences between IFRS and US GAAP pertaining to non-current assets and inventories. In episode 2, we are going to explore the differences between IFRS and US GAAP on financial instruments. I didn't want to mix up financial instruments with any other topic because we all know this is one of the most complex accounting standards everybody wants to be on top of. So in this special episode, we are going to talk about the differences between IFRS and US GAAP on the classification, recognition, and measurement of financial instruments. Before getting into details, it is important that we all understand what financial instruments are. Financial instruments are instruments that increase financial assets in one balance sheet and financial liabilities in another entity's balance sheet. Let's take an example. If a company is planning to raise money by issuing bond instruments, for the issuer who is raising financing, it is going to be a financial liability in their balance sheet. But for the party who is investing into the bond in order to receive interest cash flows as well as principal cash flows at maturity, it is going to be a financial asset. Similarly, let's take a bank. If a bank is lending money, for the bank, it is a financial asset where they will be disclosing as loans and advances in their balance sheet. But on the other hand, from a borrower's perspective, it's going to be a financial liability in their respective balance sheet. And let's talk about equity instruments. If a company is raising equity financing through an IPO, for the company who is issuing the equity instruments, it's going to be classified as an equity, but for the investor who is investing into the IPO, it's going to be accounted for as a financial assets. It is very important to understand that equity and financial liabilities, or we call them debt, both of them get classified under the broad classification of liabilities in a company's balance sheet. Financial liabilities or debt is something the company needs to repay to the external parties. However, equity is something the company needs to repay to its equity shareholders. There are differences between these two when it comes to return distribution and claims on liquidation. However, both of them come under the broad category of liabilities in the balance sheets. Let's discuss more in detail. So now, since we all understand what financial instruments are, we are going to talk about in detail the differences between IFRS and US GAAP on the classification, recognition, and measurement of financial assets and financial liabilities. Let's have a look. To begin with, we are going to start talking about financial assets. In IFRS, financial assets are classified under 4 categories, which are fair value through P&L, fair value through OCI bonds, fair value through OCI equities, and amortized cost. Similarly, in the US GAAP, financial assets are classified as held for trading, available for sale bonds and equity, held to maturity bonds, and loans and receivables. We are going to look at, under each category of these financial assets, how US GAAP and IFRS differ between each other. Let's start talking about held for trading, which is known as fair value through P&L in IFRS. These are equity or bond investments which are held by an organization primarily for short-term profit taking. At initial measurement, all type of financial assets are measured at cost. However, what we are going to focus on, each category of financial assets, their subsequent measurement. So likewise, for held for trading or fair value through P&L, investments are subsequently measured at fair value. We call this process mark to market. And remember, any gain or losses arising from this mark to market exercise must be taken to income statement for this category of financial assets. And remember, at the time of disposal, the gain or losses on disposal must be also recognized in the income statement. In addition, you are also going to see interest income for bonds and dividend income for equity investments will also be recognized in your income statement. So when it comes to held for trading, the only difference between IFRS and the US GAAP is just the terminology. In the US GAAP, we call it as held for trading. In IFRS, we call it as fair value through P&L. Let's get into the next category. Now we are going to talk about available for sale investments in the US GAAP, which is applicable for bonds and equity investment. But remember, the same thing is known as fair value through OCI bonds in IFRS. The biggest difference here is that in IFRS, the usage of this classification is prohibited for equity investments. But in the US GAAP, available for sale can be used for either equity investments or bond investments. But in terms of accounting treatment between available for sale equity and bond investments in the US GAAP and fair value through OCI bonds in IFRS is going to be exactly the same. We are going to just take a quick look at that. So what's going to happen is that at the initial measurement, these investments are measured at cost just like any other financial assets, but the subsequent measurement is going to be at fair value. And remember, the changes due to the fair value changes at each balance sheet date needs to be routed through other comprehensive income statement to equity. Under equity, a specific reserve called fair value reserve or OCI reserve can be created to show the accumulated balance resulting from the mark-to-market exercise. Dividend income from equity investments and interest income from bond investments must go to income statement. And remember, at the time of disposal, the gain or losses arising from the disposal should be taken to income statement. And most importantly, any gain or losses in your OCI reserves must be now reclassified back into your income statement. So this is something very important for this category of financial assets. But remember, this specific category is prohibited for equity investments in IFRS. But in the US GAAP, available for sale investment category can be applicable for both equity investments and bond investments. Now we are moving into the third category, which is exclusively in IFRS. So this category is fair value through OCI only for equities. Remember, we said in the previous category, when you said fair value through OCI for bonds in IFRS, we said this methodology is strictly prohibited for equity investments, and that's why there is a special category in IFRS for OCI equity. So what's going to happen is that when it comes to fair value through OCI equities, initial measurement of these investment categories, these equity investment must be at cost, and the company needs to make an irrevocable choice to account for these equity investments at fair value through OCI. Remember, the mark-to-market gain or losses on these investments must be taken to OCI, And remember, the most important point here is that at the time of disposal, the gain or losses arising from the disposal must also be taken to other comprehensive income. And yet again, the gain or losses which is included in your OCI reserve in the balance sheet should not be reclassified back into your income statement. So for this category of financial asset, the only thing that can go into your income statement is the dividend income. Nothing else can go into your income statement. Essentially, it looks like International Accounting Standard Board wants to discourage companies taking this irrevocable choice for equity investments. Basically, the default category for equity investments in IFRS is the fair value through P&L, where most of the equity investments, the IASB wants to be classified under this category called fair value through P&L, where the fair value changes are taken to income statement, because they just don't want organizations to hide behind OCI, other comprehensive income statement, which is anyway not a very popular statement among investors. However, for companies who invest in equity investments as a strategic investments to increase the stakes later on to make it like an associate or subsidiary, then it doesn't really make sense to create a P&L volatility arising from the fair value changes. And that's why the standard setters added a classification called fair value through OCI equities, but they want to discourage this classification. So they tell you that any gain or losses on the mark-to-market exercise, as well as the disposal gain or losses, must not be taken to your income statement. So anything and everything should go to your OCI except the dividend income, which can be taken into your income statement. So remember, this is a very special case in IFRS. This is not applicable in the US GAAP, because in the US GAAP, the available for sale investment category is applicable for both bonds and equity investments. Now we are going to look at the fourth category of financial assets, which is called amortized cost in IFRS, and it is applicable for held to maturity bonds and loans and receivables in the US GAAP. These investments are held by organizations primarily to receive interest and principal cash flows until the maturity of the investments. There is no intention for companies to either trade on them or sell them before the maturity date. Therefore, this category of financial asset is not applicable for equity investments, because equity investments do not have a maturity date and they do not have a contractual cash flows. Therefore, this category is specifically applicable for loans and receivables and held to maturity bonds. These investments are accounted for at amortized cost using effective interest rate. And at each balance sheet date, companies need to carry out an impairment testing based on expected credit loss model in both US GAAP and IFRS based on the probability of default. And an impairment loss provision needs to be created, and your loans and receivables and bonds are measured in your balance sheet at your amortized cost less impairment losses. So we looked at the key differences between IFRS and US GAAP in 4 categories of financial assets. Now let's get into the next slide. In this particular slide, we are going to talk about financial liabilities. It is important to remember that financial liabilities and equity instruments are just a mirror image of financial assets. As we discussed at the beginning, financial assets of one entity's balance sheet becomes financial liabilities of another entity's balance sheet. In this particular slide, we are going to focus on the classification between financial liabilities and equity instruments. It is important at the initial recognition an organization correctly classifies a financial instruments into financial liability and equity instruments, because this classification is going to have an impact on the balance sheet health of an organization, because this is going to affect your debt to equity ratio and financial leverage. It is important to recognize that there are many motivations for organizations to misclassify a financial liability into an equity instrument in order to reduce the debt to equity ratio, reduce the financial leverage, which can help the companies to increase the debt capacity. On the other hand, in order to avoid a breach of a financial covenants, a company may be motivated to misclassify a financial liability into an equity instrument. In some cases, maybe the board remuneration could be linked to the balance sheet health of an organization. Therefore, it is very important for investors to understand different type of complex financial instruments issued by an organization and the correct classification of those financial instruments between equity and financial liabilities. We are going to look at the key criteria used to differentiate financial liabilities and equity instruments in IFRS. Is the distribution mandatory or discretionary? If you look at a bank loan or a bond liability, the interest payments on such liabilities are mandatory, regardless of the company's profitability and liquidity. However, if you look at ordinary shares, the dividend distributions on such instruments are discretionary. An organization can decide whether to pay dividends or not, depending on their profitability, liquidity, and future investment plans. Therefore, instruments which has got a mandatory dividend or interest distribution will be accounted for as financial liabilities, and instruments with discretionary distribution are most likely to be accounted for as equity instruments. It is also worth looking at whether the financial instrument has a mandatory redemption at the maturity date. And some financial instruments do not have a maturity period, such as ordinary shares can be classified as equity instruments. It is also important to look at claims on liquidation. Equity instruments have the lowest priority when it comes to liquidation ranking, and most of the debt instruments rank better than equity instruments. If you look at US GAAP, financial instruments may potentially be classified as equity if the issuer's obligation to deliver cash at settlement is conditional, which would mean we are going to see many more financial instruments classified as equity instruments in the US GAAP compared to IFRS. And we are going to look at a list of instruments in the next slide, and we are going to discuss how those instruments are going to be classified in IFRS and US GAAP. A redeemable debt is a debt instrument with a specific maturity period. And during the period of maturity, the interest and the principal repayments needs to be made. Such financial instruments are classified as financial liability both in IFRS and US GAAP, because there is a mandatory interest payments as well as principal repayment during the maturity period or at the maturity. Therefore, there is no difference between IFRS and US GAAP on the classification of redeemable debt. Let's move on to the next category called irredeemable debt. Irredeemable debt is a debt with no specific maturity period. They are irredeemable so that there is no mandatory redemption at the maturity date. In IFRS, we are going to classify them either into equity instruments or debt instruments depending on the distribution. If the distribution is mandatory for a perpetual debt, it is going to be accounted for as a financial liability. So if you are looking at a perpetual debt with discretionary distribution of interest, that is going to be accounted for as equity instrument. On the other hand, if you look at US GAAP, any type of irredeemable debt where there is no mandatory redemption is going to be accounted for as equity instruments in the US GAAP. Let's move on to zero coupon bonds. What are these zero coupon bonds? These bonds do not pay any coupon interest during the maturity period. However, zero coupon bonds are accounted for as financial liability both in IFRS and US GAAP because there is going to be an rolled over interest which gets paid at the maturity, because zero coupon bonds are usually issued at a deep discount and redeemed at par. And the difference between the issue price and the redemption value reflects the rolled over interest. Now we are moving on to the ordinary shares. They are classified as equity instruments both in IFRS and US GAAP because the dividend distribution is discretionary and there is no redemption or maturity period. But remember, in IFRS we call them ordinary share capital, but in the US GAAP it's commonly known as common equity shares or common shares. Now let's look at something more exciting: preference shares. If we look at preference shares, any type of preference shares is accounted for as financial liability in IFRS because most of the time preference shares dividends have a fixed dividend payment, and dividend payments are mandatory and cumulative. What does that mean? If the dividend is not paid in a given year, it needs to be paid in arrears in the forthcoming years, which would mean any type of financial liabilities, any type of preference shares will be accounted for as a financial liability in IFRS. But if you look at US GAAP, redeemable preference shares, which means preference shares with a specific maturity period, is accounted for as a financial liability. However, irredeemable preference shares which do not have a maturity period, is accounted for as a equity instrument in the US GAAP. So this is a key difference between IFRS and the US GAAP. We're going to now look at most complex form of financial instruments, a convertible bond. What is a convertible bond? Which is a callable bond or a puttable bond which can get converted into equity instrument at the maturity date or before the maturity date. And in IFRS, these type of financial instruments are called compound financial instruments, which have the characteristics of both equity and debt. So what IFRS says is that you do a computation and split the equity component and debt component and present them separately in the balance sheet. But if you look at US GAAP, most of the times these convertible bond issues are either classified as an equity instrument or bond instruments. And also remember, in the US GAAP, this instrument is also called hybrid financial instruments because it has got the characteristics of both debt and equity. And remember, we can only split the hybrid instruments into debt and equity instrument in the US GAAP when certain conditions are met. So in this particular slide, we looked at a list of financial instruments and discussed whether they qualify as equity instruments or financial liabilities. Let's look into the next slide. We are going to look at the measurement of financial liabilities both in IFRS and the US GAAP. Financial liabilities are either measured at amortized cost or fair value both in IFRS and US GAAP. Before IFRS 9 was introduced a couple of years ago, all the financial liabilities were measured at amortized cost. So with the introduction of IFRS 9, fair value option for financial liabilities was introduced, which was later harmonized into US GAAP. So now both US GAAP and IFRS allow companies to measure their financial liabilities either at cost or fair value, depending on the circumstances. The fair value option for financial liabilities was added primarily to reduce the accounting mismatch between assets and liabilities. For example, if a company is going for a bond issue to raise financing to invest in an investment property, let's say a land, and if the land is measured at fair value and the gain or losses on the fair value is taken to income statement, and on the other hand, you have a bond liability which is measured at amortized cost. So there is a difference in accounting treatment between an asset and a liability which is used to finance the asset. So which means that the accounting treatment for financial liability previously created a mismatch between assets and liabilities, which was later removed when IFRS 9 introduced a fair value option for financial liabilities. It is important to note that any changes resulting from the fair value changes of financial liabilities must be taken to income statement. But remember, if the fair value changes are caused by the company's own credit risk changes, such changes in fair value must be taken to other comprehensive income and should not be recognized in the income statement. It is important to understand, if you think about a credit rating downgrade, which frequently happens during a financial crisis, rating agencies downgrade credit rating of many organizations. So we see the bond prices of those companies drop. So when those bond prices drop, and these will translate into fair value gains in your income statement if such companies chose to account for liabilities at fair value. On the other hand, the company's economic fundamentals are weak and they must be probably generating lower profits or even making operating losses. So if you account for financial liabilities at fair value and take the fair value changes to the income statement as gains, they are going to offset the losses on the operating performance and going to create a mixed view about the company's performance. In order to avoid this, accounting standard setters said that when there is a change in the fair value of a financial liability caused by the company's own credit risk, such changes must be accounted for in OCI and should not be taken to income statement. Any other changes on the fair value of the financial liabilities should be accounted for in the income statement for both in IFRS and US GAAP. Now we are going to talk about something more important on the same topic. Now, what happens to these OCI reserves created due to the credit risk changes arising from the credit rating downgrades and the fair value changes in financial liabilities? In IFRS, remember, these OCI reserves relating to financial liabilities must not be recycled back to the income statement even when the financial liabilities are fully settled or de-recognized from the balance sheet. However, we could make a transfer between the OCI reserve and the retained earnings, but a reclassification into income statement is not possible. But if you look at in US GAAP, the OCI reserve relating to the fair value changes of financial liabilities pertaining to company's own credit risk changes must be reclassified to income statement over the maturity period of the loan. And this is a key difference between IFRS and the US GAAP, where IFRS says the OCI reserves pertaining to financial liabilities must not be reclassified, but in US GAAP, it says the OCI reserves needs to be reclassified back to your income statement over the maturity period, or it should be reclassified back to income statement at the date of settlement when it comes to a premature repayment of loan. So we looked at a key difference between measurement of financial liabilities between IFRS and US GAAP when fair value option is chosen. Now, in the next slide, we are actually going to talk about amortized cost model a little bit in detail. So what we mean by amortized cost model for financial liabilities is that these financial liabilities are not going to be measured at fair value, they are going to be measured at amortized cost. And remember, a bond can be either issued at par value, usually $100, or at a premium above $100, or at a discount below $100. Now the question is, how do we treat this premium and discount in IFRS and the US GAAP? Remember, both in IFRS and the US GAAP, the premium or discount on the bond must be amortized over the maturity period of the bond. But in IFRS, the amortization of premium or discount relating to a bond must be done at an effective interest rate. And the straight line method of amortizing premium or discount of a bond issue is not permitted in IFRS. But remember, in the US GAAP, although they prefer effective interest rate method to amortize the premium or discount on a bond issue, they also permit the use of straight line method in the amortization of premium or discount on a bond issue. We are going to look at an illustration to demonstrate effective interest rate method used in amortized cost model. Remember, the effective interest rate method is mandatory under IFRS and it is preferred under US GAAP, which would mean that a straight line method is permitted in the US GAAP but not permitted in IFRS. So let's take a look at this example. XYZ PLC issued a bond for $110 with a maturity period of 5 years, which means the bond is issued at a premium that needs to be amortized using effective interest rate method. The par value of the bond is $100 and the coupon rate is 5%. So the interest rate of 5% needs to be charged on the par value. So $100 times 5% needs to be paid annually over the maturity period of the bond. So now let's look at how to look at this. If you really look at it, the effective interest rate on the bond, if you look at this particular calculation where I have reflected the cash flows of the bond. If you look at in year 0, you are receiving a cash flow of $110 if you are issuing a bond, and you're going to pay $5 coupon interest every year, including the last year. So that's calculated as 5% times the par value. So that's going to give you $5. That needs to come in all the 5 years. And so what's happening in year 5? In year 5, you have an interest payment of $5 plus the principal repayment, which is $100. So what's happening here is that if you look at the IRR on the bond, or the effective interest rate on the bond, is less than the par value, less than the coupon interest rate. The coupon interest rate is 5% and the IRR is actually 2.8% because the company is issuing the bond at 110 and at the maturity they're only repaying $100. So they have a saving of $20 for the whole 5 years. If you understand, there's going to be a total cash outflow of $5 for 5 years. So that's going to be 5 times 5, $25 plus $100 at the maturity. So you're going to pay altogether $125. But remember that you raised money for $110. So there's going to be a benefit for the issuer because he raised money for $110, but he's going to actually pay only $100 at the maturity. So if the bonds are issued at a premium, the effective interest rate on the bond is going to be lower than the coupon rate. But on the other hand, if you think about an example, if the bond is issued at a discount, let's say a bond is issued at a $90, where the effective interest rate is actually going to be more than the coupon interest because the bond is issued at $90 and at the maturity, the issuer needs to pay $100. So meaning the difference between $90 and $100 is an additional expense that is going to increase your effective interest rate. So let's do some number crunching to understand how this works. If you look at the beginning, what's happening, the $110, the issue price of the bond should go into your balance sheet as an opening liability. And then what you need to do is you need to charge an interest rate on that. And the interest rate is the IRR of the bond. So that's going to be 2.8%. So you charge 2.8% times your $110. That gives you 3.11. You pay a coupon payment of $5 on a net basis. You have an amortization of your premium. So look at this, what's happening. You're amortizing your bond premium, which is going to be 1.89. That's going to be the amortization for the period, for the year 1. So your closing balance is going to be your opening balance of 110 plus the interest charge that goes to your P&L based on effective interest minus the coupon payment that you make to the investors, and the closing liability will be 108.11, and that becomes the opening liability for the next year. Again, you calculate the interest as the opening balance times the effective interest rate. 2.8% gives you $3.06, and then you have a coupon payment of $5. So what's going to happen? 108.11 plus 3.06 minus $5 gives you 106.17, and that becomes the amortized cost at the end of year 2. And you continue the process all the way up to year 5. The beauty is that at the end of year 5, the bond reaches its par value, and that is when the bond liability needs to be settled. So the company who has issued the bond is going to pay $100 and settle this bond liabilities. So the interest that gets charged into the income statement is your effective interest rate, which is calculated in this particular column. And remember, in the balance sheet at the end of accounting period, this is the closing balance in your balance sheet for your financial liabilities under each of these years, starting from year 1 until year 5. And remember, this method of effective interest rate is mandatory in IFRS but preferred in the US GAAP, which means there is a straight line method which is permitted in the US GAAP but not in IFRS. Let's take a look at that. So this is the same question that we looked at earlier, but we are going to look at how do we look at this based on straight line method of amortizing the premium. The same question, you look at it, the bond was issued at a premium at $110, maturity is 5 years, and the par value of the bond is $100. Coupon rate is 5%. So what's going to happen is you need to first understand the amount of premium. The amount of premium is actually $10. So how do you come out with that? Your issue price minus your par value. The issue price is $110 and the par value is $100. So the premium is $10, needs to be amortized over 5 years on a straight line basis. So which means 10 divided by 5 is going to be $2. You see $2 in each of these years is going to be in your income statement. That's going to be a credit. So you have a coupon interest payment of $5 which you pay to your investor minus your amortization of premium, which is a gain. On a net basis, you're going to pay an interest of $3 in your income statement. This is the interest that you're going to show in your income statement, $3, although you pay $5, because the difference is the amortization of premium. The beauty is that under both approaches, if you see the effective interest rate approach, the total interest for 5 years comes to $15, and the same thing is if you look at the interest charge that goes into your income statement in straight line method would also be $15. So the difference is caused by the timing differences due to the effect of compounding. So the effective interest rate takes into account the compounding effect and is probably the most recommended method from a finance perspective. Right, so remember that again, once again, the straight line method is a big no in IFRS. We cannot use straight line method to amortize bond premium or discount. But in the US GAAP, although they recommend effective interest rate, they also permit the use of straight line method. In this slide, we are going to talk about how to account for issue costs relating to financial instruments, both in IFRS and US GAAP. Before proceeding further, it is important to understand what constitutes issue cost. If a company is going for a bond issue, there are associated costs and charges relating to bond issue, such as legal costs, underwriting fees, and any other professional charges. All such fees relating to the bond issue can be categorized as issue costs and expensed into the P&L, both in IFRS and US GAAP, if the financial liability is accounted for at fair value. But most of the time, financial liabilities are accounted for at amortized cost. Therefore, it is very important to understand the different accounting treatments between IFRS and US GAAP for the issue cost when it comes to amortized cost model. In IFRS, the initial issue cost must be deducted from the initial bond liability, which will lead to a higher effective interest rate on the bond. However, in the US GAAP, there are two options available. Option 1, which is similar to IFRS, where you deduct the issue cost from the bond liability, which will increase the effective interest rate on the bond. There is also an option in the US GAAP where the initial issue cost can be capitalized in the balance sheet as an asset, such as prepaid expenses, which is mainly applicable for commitment fees for a credit line. And these prepaid expenses are going to be amortized over the maturity period of the bond. But the problem is that there is an accounting controversy here, is that an asset is something that should generate future economic benefits. Therefore, IFRS does not permit capitalizing the issue cost in the balance sheet and amortizing them, because the issue costs do not meet the definition of assets as per International Accounting Standard Board. But US GAAP provides an option to either treat issue cost as a deduction from the initial liability or treat them as an asset and amortize them over the period of the loan. In this episode, we spoke about the key differences between IFRS and US GAAP relating to financial instruments. I take this opportunity to thank each of you who have been watching my videos and subscribing to my YouTube channel. And I highly recommend you to post a comment or ask a question. If you have any clarification on this video, I will get back to you as soon as possible. I look forward to seeing you in the final episode of IFRS versus US GAAP. Thank you and see you soon.